Vertiv just delivered another blowout quarter, driven by explosive demand for AI data center liquid cooling. Organic sales surged over 35%, and orders reached record highs. Yet, behind these headline beats, professional capital allocators are scrutinizing one specific metric. That metric is the second-half gross margin guidance. The central question for investors is clear. Are Vertiv's record orders translating into expanding free cash flow, or is the rapid push to build cooling capacity pinching margins? The provisional answer is encouraging, but conditional. Vertiv's core power and liquid cooling business is executing well. However, at a valuation exceeding 27 times price to book, the stock leaves zero room for execution delays in the second half of the year. Here is the exact financial evidence you need to evaluate before adjusting your position. To evaluate Vertiv's quarter, you must understand where the growth is coming from. Vertiv manufactures critical physical infrastructure for data centers. This includes uninterruptible power systems, power distribution units, and advanced liquid cooling units. When hyperscalers build high-density AI clusters using Nvidia Blackwell chips, air cooling is no longer enough. Liquid cooling becomes mandatory. Vertiv entered 2026 as the market leader in integrated thermal management, but rapid growth creates a secondary problem. Vertiv must build manufacturing capacity faster than its customers can deploy servers. Let us examine the primary search question. What did Vertiv actually report in second quarter earnings? Headline net sales climbed to $2.05 billion. That represents an organic sales growth rate of 36% compared to the same period last year. Regional performance was heavily skewed toward North America. America's organic net sales jumped 44%, driven by massive hyperscale order intake. If the market narrative were flawless, operating margins should have expanded in direct proportion to volume. Operating margin came in at 19.8%, beating management's baseline guidance. So where is the friction? Look closely at the cost of goods sold. Expanding manufacturing facilities, particularly the major liquid cooling plant expansion in Padua, Italy, brought elevated ramp-up costs. Gross margin reached 37.2%. That is a solid metric, but it represents a flat quarter-over-quarter trajectory, despite significantly higher revenue volume. The decision shift for Module 1 is critical. Vertiv is converting backlog into revenue rapidly. However, volume leverage is currently being offset by the capital required to expand global cooling capacity. Now, let us analyze the backlog and cash generation. Vertiv ended the quarter with a record order backlog of $7.4 billion. The organic book-to-bill ratio remained comfortably above 1.3. Market commentary often treats a growing backlog as a guaranteed future profit. But as experienced investors know, backlog is an accounting obligation until cash is collected. If Vertiv were converting these AI orders cleanly, operating cash flow should mirror net income growth. In the second quarter, operating cash flow reached $320 million. Free cash flow conversion stood at 84% of adjusted net income. This is a significant improvement over prior years when supply chain bottlenecks choked working capital. However, capital expenditures increased to $55 million for the quarter. Management reaffirmed that full-year capital intensity will stay near 3% of net sales to support liquid cooling production. Here is the key distinction. Vertiv is not suffering from a demand problem. It is managing an execution balancing act. The company must deliver custom thermal solutions for high-density AI racks on tight customer deadlines without incurring expedited freight costs or factory overtime penalties. The decision shift for Module 2 is positive for balance sheet safety, but restrictive for valuation expansion. Vertiv's cash conversion is healthy, but capital expenditure requirements will keep free cash flow growth pegged strictly to net sales growth. Before reaching a final verdict, we must address the strongest bull argument. Bullish analysts argue that Vertiv possesses a durable economic moat through its integrated power and cooling ecosystem known as OneCore. While competitors like Modine or AAON supply specialized cooling equipment, Vertiv provides the entire power-to-cooling chain from the utility grid entry point directly to the chip cold plate. Furthermore, Vertiv's co-development agreement with Nvidia for next-generation GB300 architectures positions Vertiv as a primary reference design for liquid cooling. This partnership gives Vertiv pricing power and high customer switching costs. If hyperscalers standardize on Vertiv thermal architectures, order visibility extends well into 2027. This argument is valid. Vertiv's market position in AI physical infrastructure remains elite. This brings us to the final investment decision framework for Vertiv stock following second quarter results. We evaluate Vertiv across 3 distinct scenario states. Scenario 1 is the bull case. This requires full-year organic sales growth to exceed 28%, with second-half gross margins rising above 38% as the Padua plant reaches optimal scale. If free cash flow conversion remains above 85%, Vertiv can support its current growth multiple. Scenario 2 is the base case. Organic sales growth settles between 22 and 24%. Second-half gross margins hold steady near 37%. Under this scenario, the stock is fairly valued at current levels. Future returns will depend on organic earnings growth rather than further multiple expansion. Scenario 3 is the bear case. If capacity bottlenecks or freight inflation compress second-half gross margins below 35%, or if book-to-bill drops below 1.0, Vertiv faces a valuation re-rating. At 27 times price to book, any margin compression directly threatens capital principal. Our monitoring checklist for the next 90 days contains 2 strict metrics. First, monitor the Form 10Q filing for any increase in accounts receivable aging relative to revenue growth. Second, track whether management maintains the full-year adjusted free cash flow guidance of $1.2 billion. Vertiv has proven that AI liquid cooling demand is real and expanding. But Vertiv is not the only company scaling up to monetize this physical infrastructure bottleneck. To see how Vertiv's margin structure compares directly with its primary cooling competitor, click the video on screen now. We analyze Modine manufacturing and the $4 billion liquid cooling pipeline Wall Street is watching next.